So you'll probably hear people saying BTFD or buy the dip, but the moment you do that, the dip gets another dip, and that dip gets another dip, and it just keeps dipping, 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 and dipping.
Dip, 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 dip.
And if you're new to investing or just started investing a couple of months ago, you'll probably have seen all your unrealized gains evaporate into thin air, and your portfolio is probably sitting in the red right now.
Risk losing life support systems.
Understood.
And no, I'm not a mind reader or know-it-all, but I know this because my portfolio has been down quite a bit as well. So today, let's talk about buying the dip and why I think you shouldn't do that, and for good reasons. So in the past recent week, we have seen markets as a whole dipping into really bad territories. So on a year-to-date timeline, Bitcoin has dropped from $47,000 to $21,400 as of recording. Ethereum dropped from $3,700 to $1,170, and the crypto market's capitalization is currently sitting below $1 trillion. It's down almost 50% from $2.9 trillion at its peak. And on the stock market side of things are not looking very well either. So I use the stock market to reduce my risk with crypto because it's relatively less volatile and it's a different instrument altogether, which spreads my risk when I'm investing. And yes, this video is sponsored by Habitrade, but more about them later on. So in the stock market, we are seeing the S&P 500 go down 20%, large tech firms like Google are down 25%, Tesla is down 41%, and many other stocks are bleeding out. So this might be a good time to buy some stocks, but I'm gonna tell you why buying the dip isn't gonna be the best option that you have. And with the recent rate hikes, inflation slowly increasing, and layoffs happening in the tech space, having cash on hand can be a good option because we all have bills to pay regardless of the market's conditions, and we still have to eat.
Boy, I need real food, peasant food.
So like in the previous video, having an investment plan and sticking to it during a recession is probably one of the best chances you have if you want to go through the recession unscathed. So picture this, if you're an investor just like me, who does maybe a dozen trades a year, chances are the money that we put into the stock market will be there for the next 5 to 10 years. And because we're investing for our future, our retirement, our house, our children's education, or whatever huge plan you have, and like it or not, studies have shown that 97% of traders lose money over a 300-day period. So a study in Taiwan between 1995 and 2006 shows that only 5% of traders are profitable. And a study by the SEC on forex traders shows that 70% of traders lose money every quarter, and in a 12-month span, 100% of them lose their money. And eToro, which is a broker, found that 80% of traders lost money over a 12-month period, with 36% of losses being the median. So many people would disagree with me and say that trading is better for sure, which I don't deny if it makes you money. But like I've repeated many times, I'm bad at trading, and if you are here for trading advice, you are on the wrong channel. But if you're here to watch how we can invest and do some risk management, this is the right channel for you. So do me a solid, smash that like button while we talk about today's sponsor, which is Habitrade. We all know that cryptocurrencies do have ups and downs, and this is a pretty scary roller coaster ride. And sometimes when we have those gains, we want to safeguard it and ensure that it grows and does not stay stagnant. So this is where the sponsor for today's video, Habitrade, comes in. Habitrade is the first crypto-friendly global stock investment platform that allows you to trade stocks available on the Nasdaq, New York Stock Exchange, and Hong Kong Exchange. So this means that you're able to purchase your favorite stocks like Tesla, P&G, Apple, and much more on Habitrade. But one of the unique features of Habitrade is the ability to transfer stable coins like USDT directly into Habitrade platform and start purchasing these stocks with a few taps of the button. So having our profits placed into a blue chip stock allows us to diversify our portfolio, reducing the risk that we are already taking on with our money. The interface on Habitrade is simple and easy, which is something I really appreciate because why complicate stuff? Being simple and easy also means that people or beginners who are looking to start investing can use their crypto gains to diversify into stocks that hold fewer risks. And one feature that I really like about Habitrade is the news tab. So the news tab gives me an up-to-date news and also shows me the price change of stocks that are mentioned in the news, which is a great way to get bite-sized information on the go. There is also a trending page that shows you the latest trending stocks in the market that you can look into. And by signing up with the link in the description down below, you get a free stock worth $5 when you make your first purchase of $300 in stocks, And if you purchase more than $1,000 of stocks, you'll get a free stock worth up to $20. On top of that, you'll get customized market intelligence to help you make informed trading decisions. But most importantly, always do your own research before investing any money into any investment instrument. So thank you Happy Trade for sponsoring today's video. And if you're into trading, right now there might be some good buys out there in the market, but the fact of life is that we do not know that if these are dips or these are cliffs. And if you are lucky and these are dips, you might get some profit when the market recovers, but if you manage to step on a lemon, then this will be a whole new conversation altogether. But the main point I'm trying to bring across here is to stick to your investing plan, because if you stay invested in the market, chances are we are gonna get some dips here and there through dollar cost averaging, which I'm a huge fan of. And by sticking to our investing plan that we have, we are doing ourselves a favor by not over-investing, which is a huge problem, because we might end up buying dips with money that we need in the next couple of years. And if the market takes more than a year or two to recover, our bills will continue running and someone has to pay them, otherwise our lifestyle will be affected, which will not be something that we want happening. And the next reason you shouldn't be buying a dip is that the dip is kind of like timing the market. And if we stuck to our investment plan and invested $500 a month into a broad index fund like VOO, we would have accumulated quite a fair share of it right now. And just because it's a dip right now and we buy more, this not only puts us off track on our plan, but might start putting us into a gambler's mentality who's looking for short-term gains. Like some experts say, you should never try to time the market. In fact, nobody has ever done this so successfully and consistently over multiple businesses or stock market cycles. Catching the tops and the bottom is a myth. It is so till today and will remain so in the future. In fact, in doing so, more people has lost far more money than the people who have made money. So not timing the market and consistently investing every month has multiple benefits. So one benefit is that it takes out the hard work of investing. Many of the viewers of this channel probably are working adult based on the stats that YouTube provides. And hence, our day job will probably be the main income generator for us. And by being good in our job, we'll ensure that we get consistent income, while on the side, we got some investments to provide us with supplementary income via dividends, coupons, or capital gains when we eventually release the stock. And purchasing broad market ETFs like VO can potentially give us a 10% ROI annually, which is pretty good for some capital appreciation. And coupled with some other ETFs that provide dividends, it can be a good stream of passive income that looks after itself while we excel in what we do best. And to add on to letting the investment look after itself, the last thing we want is to invest based on emotions. So just because the market is down, does it mean we have to invest more? Technically we could, but what will happen here is that we start to lose focus. Because we have invested a bit more than we should on a monthly basis, we become overly concerned because we added a few $100s just to get the dip. But when this happens, we lose focus not because we are making a lot of money, but because we have more money invested and we are worried about losing it, which will somehow affect the way we function, it will affect our moods, and ultimately it might affect our job. Many might say that I'm exaggerating, but think about it from a larger perspective. If we have stuck to our plan of investing a set amount every single month, it will become a habit in us and it will probably be an amount that we are comfortable with. And when we put a little bit more, we become a bit more emotional because more money outlay. And with social media being so fast these days, a tweet or an update or a notification can end up making you check your account to see the unrealized P&L and whether the stock has stumbled or has it gone up and much more. And this will slowly eat into your day job, which might start to affect your performance. And when your performance is affected, you might miss out on increments or bonuses, which makes you penny wise and pound foolish. So these are some of the reasons why I'm not buying this dip, but I will continue with my dollar cost averaging strategy and investing periodically when the time comes. So do drop a like if you also like dollar cost averaging. We can be DCA buddies. Subscribe and turn on the notifications if you haven't. And stay safe, invest wise, and I'll see you in the next one.